What happens when a regional war shuts down a waterway that carries roughly 1/5 of the world's oil supply? In a single trading session, US crude surged more than 13%, European natural gas futures jumped 40%, and US stock futures pointed to a drop of nearly 1,000 points on the Dow. Tonight, we examine how the expanding conflict involving Iran, Israel, and the United States is rippling through energy markets, financial systems, and global trade flows. If this confrontation stretches into weeks, as President Donald Trump indicated it might, the economic consequences could move from volatility to structural shock. Prolonged disruption in the Strait of Hormuz would affect not only oil exporting states but manufacturing hubs, shipping lanes, and consumer prices worldwide. Conversely, if de-escalation occurs quickly, markets may retrace losses, reinforcing the view that geopolitical spikes remain temporary. The difference between those paths carries implications for inflation trajectories, central bank policy, and political stability across multiple continents. The Strait of Hormuz is a narrow maritime corridor between Iran and Oman through which approximately 17 million barrels of oil pass daily, alongside significant volumes of liquefied natural gas from Qatar. Any sustained interruption tightens global supply. This week, shipping through the strait slowed to a near standstill after Iranian retaliatory strikes targeted US embassies in the Gulf and energy facilities in allied states. Simultaneously, Israeli forces struck positions linked to Hezbollah in Lebanon, widening the operational theater. Financial markets reacted immediately. Futures tied to the S&P 500 dropped 2% before the US opening bell. Dow futures indicated a potential decline of about 970 points, while Nasdaq 100 futures slid 2.3%, reflecting particular pressure on growth and technology shares. In Europe, Italy's FTSE/MIB fell 4%, Germany's DAX lost 3.6%, and France and the United Kingdom saw declines near 2.7%. The pan-European Stoxx 600 retreated nearly 3%. In Asia, South Korea's Kospi plunged 7%, Japan's Nikkei 225 declined 3%, and major indexes in China, Hong Kong, and India each dropped more than 1%. Energy markets amplified the shock. US crude rose 7.5% Tuesday, bringing its cumulative increase since Sunday night to more than 13%, and pushing prices to their highest level since January 2025. The international benchmark climbed 8%, reaching levels not seen since July 2024. Retail gasoline prices in the United States increased by 14 cents over a week to an average of 3,077 per gallon. Analysts projected that prices could approach between $3.10 and $3.20 by week's end if crude remains elevated. Natural gas markets exhibited even sharper moves. US natural gas futures rose more than 4%. In Europe, prices spiked 40% after Qatar Energy halted liquefied natural gas production and suspended several related energy products. Europe remains structurally sensitive to supply interruptions following its post-2022 diversification away from Russian pipeline gas. A shock from the Gulf compounds existing vulnerabilities. The geopolitical roots extend back decades. Iran has long leveraged asymmetric capabilities, including missile and drone programs, to offset conventional military disparities. Israel views Iranian regional influence and proxy networks as direct security threats. The United States maintains a security architecture across the Gulf to safeguard shipping lanes and allied infrastructure. When Iranian strikes hit a US embassy in Riyadh and targeted oil facilities, and Israeli operations expanded into Lebanon, the conflict moved from contained exchanges to multi-front engagement, Market analysts noted that the intensifying missile and drone exchanges across the Middle East were driving the negative risk tone. They also observed that uncertainty about the duration and objectives of the US-Israeli campaign was compounding volatility. Another research group highlighted that investors were closely watching whether Iran could escalate attacks on production facilities belonging to key marginal energy suppliers in the region. That assessment underscores how markets are pricing not only current damage but potential capacity loss. Consider the first what-if scenario. If Iran expands strikes to major export terminals in Saudi Arabia or the United Arab Emirates, removing even 2 to 3 million barrels per day from global supply, Brent crude could move sharply higher. Higher energy costs would feed directly into transportation, manufacturing, and food prices. Central banks already managing inflation risks might delay rate cuts, tightening financial conditions. Emerging markets dependent on energy imports could face currency depreciation and fiscal strain. Now consider a second scenario. If diplomatic channels reopen and shipping through Hormuz resumes within days, speculative premiums embedded in oil and gas contracts may unwind. Equity markets could rebound as traders rotate back into risk assets. However, even under de-escalation, insurance premiums for vessels transiting the Gulf would likely remain elevated for months, embedding a residual cost into global trade flows. Travel disruptions add another dimension. Tens of thousands of passengers and air cargo shipments were stranded in hubs such as Dubai after strikes in the region disrupted flight corridors. Aviation fuel costs, already sensitive to crude movements, could rise further if supply chains remain stressed. Airlines operating thin margins may pass those increases on to consumers, amplifying inflationary pressures. The broader global order faces stress when energy choke points become battlegrounds. The Gulf supplies not only Western economies, but also China, India, Japan, and South Korea. A prolonged supply interruption could intensify competition for available cargoes, reshaping trade balances. Strategic petroleum reserves might be tapped, yet those buffers are finite and politically sensitive. Financial flows reflect this uncertainty. Traders rotated from equities into government bonds, seeking relative safety. That shift indicates risk aversion rather than panic, but sustained volatility can erode business investment decisions. Corporate capital expenditure plans often hinge on energy price stability and predictable shipping timelines. As the conflict evolves, the central question is durability. Temporary volatility is absorbed. Structural disruption reshapes policy and alliances. Investors, policymakers, and households are now watching the same indicators: shipping flows, energy output, and diplomatic signals. The balance between escalation and restraint will determine whether this episode becomes a short-lived shock or a defining economic inflection point.